The global container trade remains resilient and strong, even as the shipping industry navigates economic uncertainty, geopolitical tensions, and shifting supply chains. Freight volumes are holding steady, and in some cases, even growing, a trend that has surprised many analysts. Some have speculated that this surge is due to front-loading, where companies rush to import goods ahead of potential trade restrictions, tariffs, or disruptions. However, this isn't the case. The data tells a different story. So if it's not front-loading, what's really driving container trade growth? Are global markets bouncing back, or is something else fueling this momentum? Let's break it all down and uncover the real reasons behind this trend. Recent shipping data suggests that container traffic remains strong, defying earlier predictions of a slowdown. Industry experts anticipated that high interest rates, inflation, and global economic uncertainty would dampen trade volumes. But instead, container shipping has shown resilience. Over the past year, major shipping lines and global trade analysts have reported steady, and in some cases, increasing, freight movement across key trade routes. This suggests that, rather than a short-term anomaly, the current strength in global container trade is being driven by deeper structural factors. 1. Current data trends. Global shipping giant Maersk has projected that container trade could grow by up to 4% in 2025, signaling continued momentum despite ongoing economic uncertainties. And U.S. ports have seen higher-than-expected import volumes, particularly on the West Coast, where activity surged after a temporary dip in 2023. In Asia, China's export sector remains active, but other manufacturing hubs like Vietnam and India are also seeing increased shipments, contributing to the sustained container demand. 2. Ports and trade routes. Major container hubs in Asia, Europe, and North America are reporting high levels of activity, with some experiencing congestion, a sign that trade flows remain robust. In the Port of Los Angeles and Port of Long Beach, two key gateways for U.S. trade, have handled higher-than-expected volumes, reflecting a steady pace of goods movement. Whilst in Europe, Rotterdam and Hamburg are witnessing strong container throughput, despite economic headwinds in the region. With container volumes staying strong across multiple markets, the real question is, if front-loading isn't the cause, then what's driving this growth? Front-loading is a well-known trade strategy where importers accelerate shipments ahead of expected tariff increases, regulatory changes, or supply chain disruptions. Historically, this has led to temporary spikes in container volumes as companies rush to secure goods before costs rise or logistical bottlenecks occur. For example, during the U.S.-China trade war in 2018 to 2019, American companies front-loaded imports to avoid pending tariffs, causing a short-term surge in shipments. Similarly, in 2021, when supply chain bottlenecks led to record congestion at major ports, companies rushed to secure inventory, anticipating longer delivery times. However, this is not happening in today's trade environment, and the data supports it. 1. No major tariff increases or trade policy shifts. Unlike previous years, there have been no sudden trade policy changes significant enough to trigger widespread front-loading. While tariff discussions are ongoing, particularly involving China and the U.S., there are no immediate hikes forcing companies to rush orders. 2. Importers are not stockpiling goods. If front-loading were occurring, we would see mass inventory buildup, with warehouses and distribution centers reporting excess stockpiles. But instead, recent supply chain data shows that inventory levels remain stable, with businesses importing based on real demand, not speculation. Unlike in past years, when companies overordered and later faced gluts of unsold inventory, today's importers are adopting a balanced approach, ensuring that goods are brought in as needed rather than stockpiled. 3. Freight demand matches. Consumer and industrial activity. Instead of panic-driven front-loading, the current rise in container volumes is closely tied to real market activity, both in consumer spending and industrial supply chains. And steady e-commerce demand, ongoing infrastructure projects, and supply chain diversification are fueling container movements organically rather than artificially through front-loading. So, if front-loading isn't the driver, then what is responsible for the strength in global container trade? Let's break down the real factors fueling this growth. Several key factors are driving the strength of container trade, and they all point to long-term structural changes rather than a temporary surge. Let's break them down. Resilient consumer demand. Consumer spending has remained surprisingly strong, even amid global economic uncertainty. While inflation and interest rates have impacted certain markets, overall demand for goods has not collapsed. In fact, in many sectors, it continues to rise. 1. E-commerce boom continues. Online retail has redefined global supply chains, creating persistent demand for fast-moving consumer goods. And in the U.S., e-commerce sales exceeded $1.1 trillion in 2023, with projections for further growth in 2024 and beyond. This shift is driving steady imports, as retailers work to keep fulfillment centers stocked and adapt to changing consumer preferences. 2. Retail and electronics drive imports. Demand for consumer electronics, apparel, and home goods remains steady, keeping container traffic high from major manufacturing hubs in Asia. And in the US and Europe, big-box retailers like Walmart and Amazon are adjusting inventory levels based on real-time consumer trends, ensuring that supply chains continue moving efficiently. 2. Geopolitical factors and supply chain shifts. Global trade routes are undergoing significant changes, forcing businesses to rethink logistics strategies. 1. The Red Sea crisis and Panama Canal disruptions. Attacks on commercial vessels in the Red Sea have forced shipping lines to reroute via the Cape of Good Hope, adding thousands of miles and extra costs to supply chains. As the Panama Canal, a key passage for goods moving between Asia and the U.S. East Coast, has been affected by severe drought, limiting the number of vessels that can pass through. These disruptions extend transit times, increasing the demand for shipping capacity as companies adjust their logistics networks. 2. Sourcing shifts beyond China. Many businesses are moving production away from China to Southeast Asia, India, and Mexico as part of long-term diversification strategies. The rise of nearshoring, shifting production closer to consumer markets, is boosting container flows across different trade corridors, rather than concentrating them in one region. 3. Inventory rebalancing by businesses. After 2 years of extreme supply chain volatility, businesses are now taking a measured approach to inventory management. 1. The shift from just-in-time to just-in-case logistics. In 2021-2022, supply chain disruptions led to massive delays, prompting businesses to overorder goods to avoid shortages. And by 2023, companies corrected their inventories, reducing stockpiles and cautiously adjusting supply chain strategies. Now firms are embracing a just-in-case inventory model, keeping moderate buffer stocks to avoid the disruptions seen in previous years. 2. Restocking cycles. Keep container trade strong. Many retailers depleted their inventories last year and are now gradually restocking, ensuring steady demand for container shipping. This approach prevents another supply glut while sustaining container volumes over time, rather than causing artificial spikes from over-ordering. Together, these key trends explain why global container trade remains strong, not due to front-loading, but because of fundamental changes in supply chain strategies, trade routes, and inventory planning. With container trade holding steady, major shipping carriers and logistics companies are making strategic adjustments to navigate evolving market conditions. These moves are aimed at maintaining profitability, adapting to new trade routes, and ensuring long-term resilience. Capacity management, balancing supply and demand. 1. Shipping lines are strategically adjusting vessel schedules to prevent overcapacity, which can drive down freight rates and lead to financial losses. 2. Some large carriers, like Maersk and MSC, have pulled capacity from weaker trade lanes and reassigned vessels to routes with higher demand, ensuring efficient use of available ships. 3. The introduction of larger container vessels is also helping carriers improve economies of scale, allowing them to move more cargo per voyage while optimizing costs. Freight rate adjustments, route disruptions, drive costs up. 1. Freight rates have been highly volatile, largely due to geopolitical events like the Red Sea crisis and the Panama Canal drought. 2. Routes that require longer detours, such as those bypassing the Suez Canal, have seen freight rates spike sharply, impacting the overall cost of goods transported. 3. To counteract these rising costs, some shippers are exploring alternative routes, like overland rail transport through Central Asia, or even shifting production closer to end markets through nearshoring. 4. However, container spot rates remain well below 2021 pandemic highs, meaning carriers must carefully manage pricing to remain competitive. Sustainability trends, the future of green shipping. As environmental regulations tighten, shipping companies are accelerating their green initiatives to meet new emissions standards. Some of the key industry trends include 1. Low-emission fuels. Carriers are investing in alternative fuels, like liquefied natural gas, LNG, and methanol-powered vessels, which reduce carbon footprints compared to traditional bunker fuel. 2. Carbon reduction targets. The International Maritime Organization, IMO, has set ambitious goals to cut emissions by 50% by 2050, pushing carriers to adopt eco-friendly logistics strategies. 3. Slow steaming strategy. Many shipping companies are reducing speeds, known as slow steaming, to cut fuel consumption and emissions while keeping overall transport costs lower. 4. Regulatory pressures. Governments in Europe, the US, and Asia are implementing carbon taxes on shipping emissions, further accelerating the industry's shift toward greener alternatives. Market outlook: what's next for global container trade? Looking ahead, experts predict moderate growth in global container trade, with some volatility expected due to geopolitical tensions and economic uncertainty. Key forecasts include 1. Continued trade route disruptions. The Red Sea security crisis and ongoing Panama Canal water restrictions will keep supply chains under pressure, affecting transit times and freight costs. 2. Stable but cautious growth. While consumer demand is holding, global trade faces potential slowdowns in certain regions due to inflation, interest rates, and economic uncertainty. 3. Long-term industry adjustments. Shipping firms will likely invest in fleet modernization, digital tracking, and AI-powered logistics to improve supply chain efficiency. Despite these challenges, the global shipping industry has proven its resilience time and time again, and with the right strategic shifts, the container trade will continue adapting to global market demands. So, while global container trade remains strong, it's clear that front-loading is not the reason behind this resilience. Instead, a combination of factors, from steady consumer demand and evolving supply chains to geopolitical shifts and strategic industry responses, is driving sustained container traffic across global trade routes. As we move forward, businesses and supply chain leaders must remain agile and adaptable. The shipping landscape is constantly evolving, influenced by everything from new trade policies and economic conditions to environmental regulations and technological advancements. Companies that stay ahead of these changes will be best positioned to navigate challenges, control costs, and maintain strong trade flows. The world of global trade is complex and ever-changing, and staying informed is key to understanding where the industry is headed next. What do you think about the current state of global container trade? Are we seeing a lasting trend or just a temporary shift? Let us know your thoughts in the comments. If you found this analysis insightful, don't forget to like, subscribe, and turn on notifications for more updates on global trade, shipping, and economic trends. Sources listed in the description.